So, question number one, mutual fund. Now, you all will remember that this type of sum is so frequent and so common in the past 10 years in CA Final SFM. I think the first of this type was that sum where we had Mr. Mr. Bachchan, Mrs. Charu, and whatever. Okay. So, there are three plans over here. Plan A is a dividend reinvestment plan. So whatever dividend is to be given, it will be reinvested at the NAV. Plan B is a bonus plan and Plan C is a growth plan. We know that in Plan C, units will not increase. So there will only be long-term capital gain, no short-term capital gain. But in Plan B and Plan A, since units are going to increase, there could be a scope of short-term capital gain. We have done the sum in class. So I will briefly go through the sum without investing too much time over here, because the purpose of these classes is not to illogically invest time in sums that we have done. But if the same sums are very important and coming again, if we spend around 5 minutes, 7 minutes discussing certain nuances which everybody gets it wrong, it's good, no? So take it in that way. So there was an IPO on 1st April 2009. Mr. Amit, Ashish and Arun, three investors, invested 2 lakh each at a face value 10 per unit. That means 2 lakh by 10, 20,000 units. And they chose plan B, C and A respectively. Obviously, you need to be careful. They've not written A, B and C. So Amit went for plan B, Ashish went for plan C, Arun went for plan A. Don't make a silly mistake, please. Now, look at the table. In the table, particulars of the fund over the period are as follows. So we are given date, dividend percentage, bonus, plan A, plan B, plan C, NAV per unit. On 31st July, all the three investors redeemed all the balance units. Consider the following. Long-term capital gain is exempt from tax. Short-term capital gain 10% tax. Now when these people are computing short-term capital gain, they are computing it with the help of the price net of STT. I mean to say, look at plan A. The redemption price will be 53.75 minus the STT of 0.2% in point number C. Now logically, the short-term capital gain should be computed based on 53.75. Now what they have done in the solution is that they have not calculated short-term capital gain using 53.75, but they have used 53.75 minus 0.2%. However, in the footnote, they have recalculated again that you could have used 53.75. I don't understand. If you know that the income tax rules say that the short-term capital gain is to be computed based on the gross price, not the price net of STT, why do they first do it wrong and then write in the note? So you have to take your own call. If you really want to follow ICAI, so don't use 53.75 while computing short-term capital gain. Use 53.75 minus 0.2%. Then give a note that no, alternate solution is I could have used 53.75. Now don't be frustrated and be angry upon me. It is upon you. If I would have been a student, I would have done it correctly. That means short-term capital gain shall be computed based on 53.75. I would have done it that way. Question number 2. You are required to calculate the effective yield per annum. It's point number 2, not question number 2. To calculate the effective yield per annum, that is annual rate of return for each of the investors. You know, in the mutual fund chapter, when they write effective yield per annum, they actually want to mention simple yield. Okay, simple yield, not the compounded yield. To suggest the name of the investor with the highest effective yield per annum with the difference to his nearest investor. That's okay. Based on the first solution, you can see which investor performed the best. Okay, so let me just discuss the dividend plan by looking at the table. I hope you are looking at the table. So on 31st July 2013, there's a 10% dividend. That means 10% of 10, 1. And how many units were there? 20,000. So 20,000 into 1 is 20,000. That 20,000 is invested at 30.7. So 20,000 divided by 30.7. 20,000 divided by 30.7. That becomes how many units? 651.46 units. So 651.46 units we get on 31st July. And then once again, so the total units is 20,000 plus 651.46. Okay, that's the cumulative units. You have to make a column for cumulative units. Then on 31st March 2014, we have 35% dividend. That means 3.5 into the cumulative units. Okay, 3.5 into the cumulative units. Cumulative units was 20,600 something, na? So we get the dividend amount. That dividend amount divided by 58.42 shall be the number of extra units we get. And once again, that extra units will be accumulated. And so on. So we know the process, how it is to be done. Okay. So we'll get the cumulative units at the end. And all the units will be sold at 53.75 less 0.2%. Correct. And then you have to pay short-term capital gain on those units which were purchased on 25th March 2019 at 48.1. So there the short-term capital gain according to me will be 53.75 minus 48.1 multiplied by number of units multiplied by 10%. Okay, that will be the short-term capital gain. You deduct that and you deduct the initial investment of 2 lakh, you will get the profit. Whatever profit you get, that profit divided by 2 lakh into 100, that is the return over 10 years and 4 months. 10 years and 4 months. But you want an annualized return. So 10 years and 4 months is how many months? 124 months. So the return for 12 months would be into 12 by 124. There is no question of anybody thinking that, sir, this was too fast. Because we have done all this. I can't redo it. No? Nor is it sensible that I keep on showing you the solution over here, how it is to be done. Just remember, there will be a problem in the short-term capital gain because they have once calculated it using 53.75 minus 0.2%. But then written a note that no, you could have used 53.75. I am in favor of using 53.75. I think they'll give marks because they've already given the note. In plan B, the bonus plan, it's still easier because on 31st March 2014, you get a 5:4 bonus. So the number of units you get is 20,000 into 5 by 4. 20,000 into 5 by 4. That becomes 25,000. So 25,000 plus 20,000 is 45,000 units. Next, 45,000 into 1 by 3. 45,000 into 1 by 3 is 15,000. We add it, we get 60,000 units. Then 60,000 into 1 by 4, that is also 7,000. 60,000 into 1 by 4, 15,000 units. So we get 75,000 units. So altogether we have 75,000 units at the end, which we sell at 22.98 minus 0.2%. Correct? And then once again you calculate the short-term capital gain. Very important. Although we have all studied in income tax that while computing capital gain on bonus shares, the cost of acquisition is taken to be 0, but institute has taken 19.95. So remember that you are supposed to do the sum wrong. You have to use 19.95 as the cost of acquisition for bonus shares. Do not teach me or send me messages that, sir, we have always learned from CA Inter that cost of acquisition is 0 for bonus shares. I am telling you what is done by ICAI. Follow the same. And plan C would be obviously easy. Okay, so this is the discussion to question number 1. The question has already been done in class, okay, but it's still very important. So please be very, very careful about not doing any mistake in the question. Thank you. Question number 2. Now this is also a traditional sum on mutual fund done in class, very nicely done in class. Then why am I doing it again? Because I consider the sum to be extremely important for the exam. So even if I have included it, and I am discussing it, I am 100% sure there will be few students who might have missed out or who might have done it wrong. But as a result of my 5-7 minutes audio, they will get it right. So I don't want to run the risk. So please bear with me. So this is the sum on missing figure. If you read the last line of the sum, calculate NAV on 31st March 17, 31st March 18, 31st March 19. I used to call them XYZ. Okay. Let's see. So on 1st July 2016, Mr. X invested 50,000 at initial offer in mutual fund of face value 10 each. So he got 5,000 units, 50,000 by 10. On 31st March 2017, that means 1st July 16 to 31st March 17, that's 9 months. A dividend was paid at 10%. So 10% of 10 is 1. So 1 into 5,000 is what? 5,000. And annualized yield was 120%. So annualized yield was 120%. That means the 9-month yield was what? 90%. You already know that this sum, okay, I'm assuming that you have done the sum once, and when I read the sum further, I will reiterate it, that this sum is on dividend reinvestment plan. That means the 5,000 units 5,000 dividend that we were supposed to get, 5,000 into 1, that was not received by us, that was reinvested by us, correct? So We have a 90% return in the first 9 months. So if you invest 50,000 and you earn 90%, how much do you earn? 45,000. Correct? If you invest 50,000, you earn 90%, you earn 45,000. Out of the 45,000, 5,000 is dividend. So the remaining 40,000 is in the form of NAV appreciation. Na? The remaining 40,000. Now the remaining 40,000 is on how many units? On 5,000 units. So the NAV appreciation is 40,000 divided by 5,000. NAV appreciation is 40,000 by 5,000 is what? 8. That means the NAV on 31st March 2017 is 18. 10 plus 8, 18. Hope you understood. 10 plus 8, 18. It's clear cut logic. So 18, and how many units did we get on this date? We got 5,000 divided by 18. The 5,000 dividend was reinvested, so 5,000 by 18, that is 277.78. Okay, we write it down so that we don't miss it out because I'm solving the sum verbally. So 277.78 plus 5,000. 277.78 plus 5,000, total number of units that we have is 5277.78. Okay, 5277.78. Now, let's proceed further. On 31st March 2018, that means 1 year later, 20% dividend and capital gain of 0.6 per unit was given. So 20% dividend is 2 and capital gain distribution is 0.6. The 2.6 is the distribution. So 2.6 multiplied by the cumulative units. 2.6 multiplied by the cumulative units, 5277, whatever the figure was. It's coming on my calci 13,722.22. Rupees 13,722.22 we should have received, but this 13,722.22, this was reinvested at the NAV on that day. Let's call it Y. So we don't know the Y. We don't know how many units we got. Let's read further. Mr. X redeemed all his 6271.98 units when his annualized yield was 71.5% over the period of the holding. Now, how did the units become 6271? That means the increase in the units, that is 6271.98 minus the cumulative units we had, 5277.78. The increase in units is 994.202 on my calci. Now these extra units, 994.202, which you should write and save, these extra units were purchased from that dividend amount, the distribution amount, the 13,000 amount. So 13,000 something divided by the extra units. 13,000 something divided by the extra units is coming to 13.80. So 13.80 is Y. 13.80 is the NAV on 31st March. Okay. So I got two answers. 18 is the NAV on 31st March 17 and 13.80 is the NAV on 31st March 18. Okay. Now it's saying that we earned 71.5% over the period of the holding. 71.5% annualized yield over the period of the holding. Annualized. So 71.5% is annualized. Now what is the total return? See, our total horizon is 2 years and 9 months. Total horizon is 2 years and 9 months. That means 2.75 years. So if we do 71.5 into 2.75, 71.5 into 2.75, that is 196.625% return. So 196.625% return on 50,000. 196.625% return on 50,000. 196.625% return on 50,000 is coming to 1,48,312.5 is what we earned. 1,48,312.5 is what we earned. If we earned this amount, that means this plus 50,000. That means this plus 50,000 is the redemption value at the end. 198,312.5. So 198,312.5 should be the total value of the 6271.98 units. So let's divide by that. Divide by 6271.98. Divide by 6271.98. It comes to 31.61. I hope I am not doing a mistake. Okay, I hope I am not doing a mistake because I feel that I have done some mistake. The NAV initially, let's go down. The answer, I'm checking the answer. No, the last NAV is not matching. So let me just once again check where I made a mistake. Let me go to the question and check where I made a mistake. Just 1 second. So the annualized yield was 71.5% over the period of the holding. Okay, let's try 71.5%. So I think I made some calculation mistake, okay, because the process was correct. Let's do it again. 71.5% is the annualized yield. So my holding period is 2.75 years. 71.5 into 2.75. 71.5 into 2.75 is 196.625. So 196.625% of 50,000. 196.625% of 50,000 is 98,312.5. Yes. Now 98,312.5 plus 50,000 is 1,48,312.5. So this is the ending value. 1,48,312.5 divided by 6271.98. Divide by 6271.98. That's coming to 23.65. So 23.65 is the NAV on the last date. Okay. Once again, if I seem to have spoken fast, this sum has been done by us. You have to be able to solve the sum on rough in a speedy manner. Okay. Because if you sit down to write and solve each and every sum, how will you be able to cover so many sums in SFM? Okay. So it is easy stuff. Of course, when you listen to somebody in fast calculations, you may sometimes miss out the stuff. So try it on your own end. Initially, it was very easy. 90% return on 50,000, 45,000, 5,000 gone, 40,000 by 5,000, 8 rupees appreciation, so 18. Next also it was easy. The last one also it was easy, but it was more maths, so numbers were thrown at you. So no change in this sum, easy sum, please do it right. Thank you. For question number 3, let me first of all revise the stuff with you. On the screen you can see that I have given a chart in which I have written RP minus RE. RP is the return earned by a fund manager and RE is the required rate of return as per security market line. That means RF plus RM minus RF into beta. So RP minus RE is the Jensen's alpha, that is the extra return that the fund manager has earned. This is called return from total selectivity. Now we split this into two parts. On the left side, we have RP minus RE as per CML. Now, you know CML, capital market line, is RF plus Sharpe ratio into SD. RF plus Sharpe ratio into SD. Sharpe ratio of whom? Sharpe ratio of the market. That means the slope is RM minus RF divided by sigma M. RM minus RF divided by sigma M. So it's RF plus Sharpe ratio into sigma P. So CML considers total risk while SML considers only systematic risk. So when you do RP minus CML, you get the return earned by the fund manager from skill. On the right hand side, you have the residual term, which is CML minus SML. Now this is the return he should have earned because of unsystematic risk. Okay, return from unsystematic risk. So Jensen alpha is split into two parts. The left part is called skill or net selectivity. Net selectivity. And the right side part is called return due to inadequate diversification or unsystematic risk. Okay, so this is the knowledge. But when we see the sum, question number 3, then you will find that in this sum, ICAI has done it wrong. When they were asked to calculate return from skill, they calculated Jensen's alpha, that means RP minus RE. And when they were asked to calculate return from unsystematic risk, they did RM minus RE. They compared the RE with RM. Now that's totally bullshit. So you have to remember the solution. You have to remember the solution. You have to mug up the solution. Okay, you have to remember that you have to mug up the solution. The solution is wrong. The first part is also wrong. The second part is also wrong. Let us now get into the sum. So we look at the sum. We are given the returns of portfolio A and the market portfolio for the last 12 months, Jan to December, and the standard deviation is given at the end. You are required to find out the monthly returns attributable to the sheer skill of the portfolio manager. So this should have been RP minus CML, but they have done RP minus SML. Even to do RP minus SML, we require beta. What is the formula for beta? R into sigma y by sigma x. So we require R because we already have sigma y 1.6223 and we already have sigma m, which is 0.9498. So we need the correlation. Second part, what part of the monthly return is attributable to the higher risk assumed by the fund manager? So that extra return is the unsystematic risk. So this should have been CML minus SML, but the institute has compared RM with RE. Assume that RF is 12% and the portfolio is fully diversified. So portfolio fully diversified means what? It means correlation is equal to 1. So the beta of the portfolio is 1.6223 divided by 0.9498 because correlation is 1. 1.6223 divided by 0.9498, which is coming to 1.708. That's the beta. I hope there is no confusion over there. They've computed the beta by some complication. Do not do the complication. Go to the original formula. Also, the RF, which is 12%, is per annum. We'll make it monthly. That is 1%. So we'll take the RF as 1% in the sum. Okay. So you have everything, but they have solved it wrong. Let's look at their solution. So I'm going to the solution. So if you see the solution, the first table, they have computed the average return 2.1825. This is my RP. They have computed the market return 1.4558. This is nothing. This will be used in CML SML equation. So now they have copied the figure. RP, RM, sigma P, sigma M perfect. Since the portfolio is diversified, they should have taken R equal to 1 and computed beta. So whatever method they applied, the beta is 1.6223 by 0.9498. That is 1.708. That's fine. Now we go further down. Portfolio A is comparable to portfolio with the beta of this. Now they have done expected monthly return. They want to say required return as per SML is RF plus RM minus RF into beta. They got 1.7785. No complaints. Next. Return due to net selectivity, RP minus required return as per SML. This is wrong because return due to net selectivity is RP minus CML. So this answer is wrong. Second part, return due to higher risk assumed by the portfolio manager. So they have done the RE as per SML minus the RM. RE minus RM. Now what is this formula? So you have to mug up the solution. If the sum comes again, just remember what to do in this same sum. But if a new sum comes, do the correct solution as indicated by me in the notes. Thank you. So question number 4, very easy sum on the indifference return. So this particular chartered accountant, if you look at the sum, he's earning 15% by investing in stock market on his own. But now he's thinking about investing in a mutual fund. But the mutual fund charges 6% initial expense, 2% recurring expense. How much return the mutual fund needs to earn to provide Mr. Alex 15%? So obviously mutual fund has to earn more. It is 15 divided by 0.94 plus 2. 15 divided by 0.94 plus 2, 17.957%. Okay, I can say by logic and formula, suppose invest 100, then 6% goes as initial expense. So we are left with 94. On the 94, he has to earn x minus 2, 94. He has to earn x minus 2. Okay, so that he gets 15 and you can solve for x. But what's the sense in complicating when this sum has come for around 80 times in the exam? You can straight away apply the formula, which is 15% the return required by him divided by 1 minus the initial expense. That means 15 by 0.94 plus 2. Okay, 17 point whatever percent. Please check the presentation of the symbols used by them. Okay, although I think they are not concerned, but still, if the sum is repeated, what's the harm in looking at the symbols used by them? Question number 2 was a new inclusion which was not done in class. Mr. Alex's current annual professional income is 40 lakhs. Now this guy is earning 40 lakhs, chartered accountant. His portfolio value is 50 lakhs and now he is spending 10% of his time to manage the portfolio. So he could have spent the same 10% on his practice, but he is spending 10% in managing the portfolio. Okay. If he spends the time on profession, his professional income will go up in the same proportion. So 10% of 40 lakh, 4 lakh he can earn. Okay, if he invests in mutual fund, because his time would be saved. He's thinking to invest his entire portfolio into multi-cap fund, assuming the fund's NAV will grow at 13% per annum. Okay. You are requested to advise Mr. Alex whether he can invest the portfolio into multi-cap funds. If so, what is the net financial benefit? Okay. So in the second part, we have alternative 1, invest in the mutual fund, alternative 2, invest by himself. So if we invest in the mutual fund, I'm looking at the question, I'm not going to the solution at all because there's no need. If we invest in the mutual fund, we are going to earn 13% of 50 lakhs, which is 6.5 lakhs. 13% of 50 is what? 6.5 lakhs. And we are going to earn 10% of 40, which is 4 lakhs because our time would be saved. Okay, so we are earning 6.5 lakh plus 4 lakh, which is what? 10.5 lakhs. But these guys have also added 40 lakhs. Now, I think 40 lakhs is irrelevant because he would earn anyways. But still, you want to copy the institute. So, plus 40 lakh. 10.5 plus 40 is equal to what? 50.5 lakhs. So, 50.5 lakhs is his income if he invests in multi-cap fund. Now, if he invests in shares by his own, then he's earning 15% when the sum started. So, 15% of 50 lakhs. 15% of 50 lakhs is what? 7.5 lakhs. 7.5 lakhs he's earning and plus he's earning 40 lakhs as professional income. That's 47.5 only. So 47.5 versus 50.5. That means he can earn 3 lakhs extra if he invests in multi-cap fund. That's what you have to explain. A very, very easy question. And of course, the question should have said that in the second part, you are supposed to ignore the 6% initial expense and recurring expense. That's not given. So sir, then how did you know it? I knew by looking at the answer. Sir, you are cheating. Yes, I am cheating. Okay. If you want to clear the C exam, you got to do as per them. Okay, when I first solved it without looking at the solution, I also included the initial expense and the recurring expense in the multi-cap part, but the institute has not done the same. So please follow ICAI. So question number 5. This is a nice sum on calculation of NAV, slightly different as compared to the old sums of this type which we had done in class. If you look at the sum, basically we have to find out NAV. So we have this portfolio where there are 5 sectors in which investment in shares has been done. The investment amount is given: pharmaceutical, construction, service sector, IT and real estate. If I am logical, then I will take you down into the same sum and you will find that the sectoral index is given. Index on the purchase date, index on the valuation date. So accordingly we can apply unitary method. For example, if we go up in the pharmaceutical, we invested 79. Let's go down. And the index changed from 260 to 465. So 79 into 465 by 260, that's the value of the pharmaceutical. 79 into 465 by 260, that's coming to 141.288. That way you will value the construction, service sector, IT and real estate. Perfect. Let's go up. So if I go up, now we have investment in bonds, listed, unlisted. Okay, the listed bonds, they have a 14% coupon. They have a face value of 12 crores. If we look at the last line in the table, we are given the market expectation on listed bond is 8.842%. That's the YTM. And the maturity of the bonds is not given. So it is but logical to assume that they are perpetual bond. So the market value of a perpetual bond is A by I, where A is the coupon amount. So 14% of 12 crores divided by 0.08842. 14% of 12 crores divided by 0.08842. 14% of 12 crores divided by 0.08842, it's coming to 19 crores. It's A by I, 19 crores. And unlisted bond, the valuation is not given. So we take it to be 7 crores only. So we have valued the entire stocks. We have valued the listed bonds, 19 crore. Unlisted bond, we take it to be 7. We add all of them up. That's total asset. Expense payable, item number 4 is given. Sorry, cash and cash equivalent is given. We add, that's total assets. Then expense payable we deduct. Correct? So total assets is the total portfolio plus cash and cash equivalent minus expense payable. When we do that, we get the net assets. I think that's the first question. The first question is NAV of the fund. So NAV of the fund is that only. Let's look at the solution. You can see in the solution, it's solved in the same manner. All the 5 sectors have been valued by unitary method. Listed bond 19 crores, unlisted bond 7 crore, add cash less expense payable. So NAV is coming to 415.665 crores. That's the first part. Okay, and since we are in the solution only, you can see the second part, NAV per unit. So 415.665 divided by number of units. That comes to 98.97. So the first and the second part are over. For the third part, let's move into the question. So in the third part, it's saying if the period of consideration is 2 years and the fund has distributed rupees 3 per unit per year as cash dividend, that means in 2 years, 3 into 2, 6, ascertain the net return. So to calculate the net return, we would like to apply the formula dividend, that is 6 rupees, plus the change in NAV divided by beginning NAV into 100, correct? 6 plus the change in NAV by the beginning NAV into 100. Ending NAV we have already calculated in part 2, okay, part 2 of the question. We have calculated the ending NAV. So for part 1, we need the beginning NAV. Let's go back to the table again of the question. Okay, so if we are looking at the table again of the question, so the beginning NAV is, we can just add up, 79 plus 31 plus 56 plus 34 plus 10 plus 12 plus 7. So that was the amount invested at that time. Okay, that divided by number of units can be taken as the beginning NAV. Let's check the solution. So if you look at the solution, they have done the same. Investment in shares, investment in bonds, 229 divided by 4.2, 54.52. So 54.52 was the NAV. I'm looking at the solution, and 98.97 is the NAV. So change in NAV is 44.45. Dividend is 6. So we earned 50.45 by investing 54.52. Okay, we earned it in 2 years. So into 1 by 2 into 100. 50.45 by 54.52 into 1 by 2 into 100. That comes to 46.27%. Now the question is saying ascertain the expense ratio. Ascertain the expense ratio. So if we look at the question nicely, after the second table, it is given the fund has incurred the following expenses: 480 lakhs, 150 lakhs, 38 lakhs. So expense ratio is basically the expenses divided by the average assets under management. Average assets under management. Now surprisingly, ICAI has not printed the answer itself. God knows what they're doing. So what we can do is that the total expense, we can add a 480 plus 150 plus 38, that's coming to 668. Now we have to divide by the average assets. The best thing is that the average assets is the opening and the closing divided by 2. I'm not talking about the NAV per unit. I'm talking about the net asset value. Okay. We calculated the closing in the first part, NAV of the fund, and we calculated the opening when we did the third part. Okay. That time we calculated the cost. No? I'm not talking about the cost per unit, I'm talking about the total cost. So the initial plus the ending divided by 2 is the average assets under management. So expenses divided by the average assets management into 100. That should be the answer, but then it's 2 years. So maybe you have to do into half. Why do I say maybe? Because ICAI is not given the solution. So what do I do? Now question number 6 is a very good sum. Now this is how the CA Institute is nowadays twisting. Okay, anybody who has done just the practice manual and not understood, they will never be able to do such sums. They will be totally taken aback. So in this question, they are saying that during the year 2017, an investor invested in a mutual fund. The capital gain and dividend for the year was 3 per unit, which was reinvested at the year-end NAV of 23.75. The investor has total units of 26,750 at the end of the year. Remember, this is units at the end of the year. That means the initial units plus the units received from reinvestment. NAV has appreciated by 18.75% during the year. So we have the ending NAV 23.75 and that is an appreciation of 18.75%. So we can find out the beginning NAV. Okay, so 23.75 divided by 1.1875. 23.75 divided by 1.1875 is 20. So 20 was the beginning NAV. And there was an entry load of 0.05 at the time when the investment was made. So the investment was made at 20.05, correct? Investor lost his records and wants to find out the amount invested and the entry load in the mutual fund. So very easy. He has 26,750 units at the end of the year. How? Let the initial units be X. If the initial units are X, later he got dividend of 3X which was invested at 23.75. So 3X divided by 23.75 plus X. I repeat, 3X divided by 23.75 plus X should be 26750. Solve for X. So that X is coming to 23750 units. Perfect. So initially he invested in 23750 units. So what was the investment amount? 23750 multiplied by 20.05. That's the investment amount. What's the entry load? 23750 multiplied by 0.05. Okay, very good question. Now question number 7, I always enjoyed solving this question verbally. Okay, so I'll do it that way only. You can also solve it verbally with me or on the Calci. Nice sum, done in class once. Let's do it again. It just refreshes the mind. A mutual fund raised 150 lakhs by issuing 15 lakh units at 10 per unit. The fund invested in several capital market instruments to build a portfolio of 140 lakhs. Initial expense 8 lakhs. So where is the 2 lakh? Cash in hand. Remember, we have to find out the ending cash balance. So 2 lakh is the initial cash balance. During the month of April, the fund sold certain investments costing this much for this much. So 47 lakh, the cash balance goes up. So 2 plus 47. Keep a track, please. 2 plus 47. And use the proceeds to purchase certain other securities for 41.6 lakhs. Minus 41.6 lakhs. Hope you are doing 2 plus 47 minus 41.6. Up till now, I have got 7.4 lakhs. The fund management expenses for the month amounted to 6 lakh, of which 50,000 was in arrear. So minus 5.5 because we paid 5.5 lakhs. We are getting 1.9 lakh cash in hand right now. The fund earned dividend of 1.5 lakh plus 1.5 lakh. So we are now getting 3.4 lakh as the cash balance. And it distributed 80% of the realized earnings. Now what is the realized earnings? Okay, we have got 3.4 lakh over there. Now let's find out the realized earnings. Now there was a capital gain of 47 minus 44.75. That is 2.25. And plus the dividend. 2.25 plus 1.5. That is the realized earnings. 80% of that into 0.8. 3 lakh. So 3 lakh was distributed. So 3.4 lakh minus 3 lakh equal to 0.4 lakh is the ending cash balance. 0.4 lakh is the ending cash balance. There is no question of, sir, you have done it fast. You can holly look into the solution later on. So 0.4 lakh is the ending cash balance. The market value of the portfolio on 30th April is 147.85. Okay, so add the market value of the portfolio. 0.4 plus 147.85. And minus what's the liability? 50,000 was in arrear, so minus 0.5, minus 0.5, okay, cash balance plus market value minus 0.5 liability, we get 147.75 lakhs, 147.75 lakhs for how many units? 15 lakh units, divide by 15, so the NAV is 9.85, that's very bad, the NAV has fallen down, it's 9.85 at month end, it was 10 at the beginning. An investor subscribed to 1,000 units on 1st April. How does it care? He bought 1,000 or 10,000 units. Let's ignore that. And disposed of at closing NAV on 30th April. Okay. Determine the annual rate of return. So the investor purchased at 10 and he sold at 9.85. He lost 0.15. And what was the distribution? The distribution, if you remember, was 3 lakh. So 3 by 15. 3 by 15 is what? 0.2. So the distribution was 0.2 and the capital loss is 0.15, or the net gain is 0.05, because the return is the distributions plus the change in NAV divided by initial NAV into 100. So distribution is 0.2, change in NAV is negative 0.15 divided by 10 into 100. That's 0.05 by 10 into 100, which is 0.5% in 1 month. So annualized return is 0.5 into 12. That is 6%. 0.5 into 12, 6%. Yes, it should be done verbally so that you have complete command. And believe me, when you do costing and other subjects, you have much more complicated figures. This figure should not be complicated for you at all. So question number 8 is very, very easy. You have to calculate the front end load and the back end load. There are two solutions given. One is correct, the other is incorrect. But everybody will like the incorrect solution because the incorrect solution is very easy. So in the incorrect solution, they have calculated the load as a percentage of NAV. That means the front end load is 10.204 minus 10 divided by 10 into 100, 2.04%. And the back end load is 10 minus 9.8, that is 0.2 divided by 10 into 100, 2%. I think everybody will love the solution, and Institute has given the solution. But if you want to calculate the actual answer, in that case you can follow the first solution. The first solution which says that the POP should be NAV divided by 1 minus front end load. Solve for front end load. And the redemption price is the NAV into 1 minus back end load. So you can solve it that way, but I would recommend enjoy the simplicity. Okay, the second solution is better.